Hello and welcome to another episode of Nothing Ventured News for May 2026. My name's Arish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. And in this news segment, which I run every month, we take a look at venture more holistically and see what trends are coming through. And the reality is that it's getting harder and harder to nail down what those trends really look like and where venture is actually going, because the market is really active on paper, but most of that action is concentrated in very few hands. So the main market is concentration, not broad strength. The most important main number is not how much capital went into venture, it's how little of the ecosystem really drove the result. PitchBook and NVCA's Q1 report mentions that in Q1 2026, US venture deal value hit $267.2 billion. And exit value hit a whopping $347.3 billion. Both are incredibly eye-catching numbers. I don't think any of us could debate that. But the same report says that if you exclude the 5 largest deals and exits, those figures fall by 73.2% and 86.6% respectively. Now just think about that. That means that something like 25+% and 14% of both deal and exit values are outside of the top 5 deals, which is a pretty big number. JP Morgan, on the other hand, says that the top 5 deals captured roughly 3/4 of Q1 venture investment, whilst conflict and tariff uncertainty kept the rest of the market more fragile. And I think that is a trend that we are going to continue to see throughout 2026 and potentially even beyond. So this is not a clean rebound. It really is a market where the top line flatters the underlying health. The venture market is functioning, but in a very barbelled and access-driven way. Now, if you strip out the consensus mega deals, the rest of the market really still looks massively selective, very much slower, and definitely a lot harder. So are we mistaking a few huge financings for a genuine market reopening? And equally, has venture become too concentrated to do its real job, which is financing the next layer down? And finally, if consensus rounds dominate returns and headlines, where does genuine discovery happen now? And this is a theme that I've heard a lot of VCs telling me over the course of the last few weeks, and that is there are incredible numbers of founders coming across their tables in terms of deal flow. It's actually getting really hard to separate that signal from noise and really understand which of these are going to have truly outsized commercial outcomes. So once you accept that the headline market is concentrated, the next obvious question is whether the system is actually generating liquidity. And we talked about this in April as well. Liquidity is still the real pressure point. The argument has moved on from can companies raise to how do investors, founders, and employees actually get their money back. So again, NVCA's 2026 yearbook says that US VC-backed exits reached $217.1 billion across 1,463 deals in 2025. The same yearbook says that secondary market volume reached $106 billion in 2025. The WEF's May 2026 report says that the asset class is under real liquidity strain because exit activity has been slow and capital recycling has weakened whilst LP patience is being tested. Wellington's 2026 outlook says that secondaries are now a core liquidity lever rather than a side tool. So improving liquidity is not the same as easy liquidity because the strongest assets now have multiple paths, whether that's IPO, M&A, tender, continuation vehicles, or structured secondaries. But everyone else is still stuck longer than they expected to be. So how should we think about this? Are secondaries solving the venture liquidity problem or just managing it? Does more structured liquidity make the asset class healthier or simply a bit more opaque? And if 2026 still needs this much engineering around exits, how repaired is the market really? This does not mean that secondaries are a magic fix, but they are part of that new plumbing. And it's simply not true to say that the backlog has cleared. Really, liquidity has improved, but it is still very selective and engineered. And when liquidity is constrained, fundraising power concentrates even more heavily with the firms that LPs already trust. So what does this mean? Well, fundraising power is concentrating with established managers. One of the most under-discussed May stories is not just startup concentration, but GP concentration. The NVCA says that traditional VC fundraising in 2025 totaled $67 billion across 585 funds. The top 10 funds captured $22 billion of that, which is just under 33% of all venture capital. First-time fund formation fell to 101 funds, the lowest level in roughly a decade plus. By the press release framing and the yearbook graphic, the comparison really goes back to 2007. PitchBook's and NVCA's Q1 webinar summary says that 5 firms accounted for nearly 73% of quarter fundraising, driven by LP preference for brand name managers over emerging managers. And again, we're back to that barbell effect. So this is a shrinking funnel for new fund managers. The market is simply not picking startup winners, it is picking manager winners. And that can make venture more conservative over time, even whilst rounds get bigger. So again, how do we think about this? Well, we should question ourselves as to what happens to the discovery function of venture if fewer new managers get funded. Does concentration improve quality, or does it reduce the diversity of bets and networks? And if LPs are increasingly backing incumbents, where do unconventional founders go to get discovered? This is not to say that emerging managers are dead, but the pipeline is under real pressure. Whilst the press release says the lowest since 2011, the yearbook summary page actually says it's the lowest since 2007. So we do need to think about how important this issue actually is. But the market is not only AI and not only the mega funds. There are still real pockets of conviction elsewhere. Capital outside frontier AI is still moving, but into specialist, strategic pockets. Non-AI capital has not disappeared. It has just become much more choosy, strategic, and infrastructure flavored. So again, fintech infrastructure and specialist software still broadly holds, but the stronger examples in May sit in space, energy, and AI infrastructure. Reuters reported Goldman Sachs is set to lead the SpaceX IPO, which is targeting an enormous valuation in the trillions, which could reshape late-stage tech funding and liquidity expectations. They also reported that Google and Blackstone are launching a new AI cloud business with $5 billion of initial equity and potential total investment of $25 billion built around data centers and TPU access. Fintech Futures remains useful for color on fintech infrastructure and stablecoin or payment rounds, but this is more around supporting that narrative that fintech is still strong, rather than really explaining the broader thesis. The non-AI story is not a broad software recovery. It is specialist vertical conviction. Capital is flowing where there is infrastructure scarcity or strategic and sovereign relevance. That makes the market look less consumer and more industrial. So again, how should you think about this? Well, the questions to ask yourself are which sectors now attract capital because they are strategically necessary rather than merely high growth? And are we entering, as I seem to be seeing across the conversations I have with both founders and investors, a more capex-heavy venture cycle? And does a giant SpaceX IPO lift the whole late-stage market or just mostly reprice one exceptional asset? This is not just to say that non-AI is thriving. Really, what we're saying is that niche winners will still get funded. That leads naturally into the last point, which is that founders are no longer just choosing investors, they are choosing ecosystems. Platforms are starting to behave like venture ecosystems. Money is no longer the only bait. The new competitive edge is compute, tokens, distribution, and ecosystem gravity. And as you've heard on this podcast before, this really plays into the fact that the moats that you have to play with have shrunk considerably down to potentially just distribution, hardware, and proprietary data. YC publicly posted that OpenAI is now offering $2 million in tokens to every company in its spring and summer batches, with the deadline extended so that more founders can participate. TechCrunch and Business Insider reported that the offer is tokens for equity via an uncapped safe, which makes the trade-off explicit. This is access to compute in exchange for future ownership. And this really matters because the old venture offer was capital plus brand. The new one is capital adjacent resources plus platform leverage. And OpenAI is not just investing, it is recruiting the next layer of ecosystem dependence. This is the platformization of startup formation. And the real competition is not just who funds founders, it is who gets them building on your rails early. So how should we approach this issue? Well, the question I ask myself is, does this become the normal model for frontier platforms, tokens or credits for equity? And is this a better deal for founders than cash, or a subtler form of lock-in? Whereas in the past, you could use cash to fund growth through hiring or marketing or development. Now, this sort of funding lends itself simply to one form of strategic push. And what happens to independence if the most valuable input is controlled by a handful of platforms? Now, this isn't a universal venture shift. It is a frontier platform signal and not a whole market standard, but it does really show directionally where things may be heading. So the May story is not simple optimism. It is a market reorganizing itself around power, liquidity, and ecosystem control. So May 2026 is a market structure story. The numbers look strong, but the strength is concentrated. Liquidity is better, but engineered. And the most powerful platforms are starting to behave like ecosystems, not just companies. Venture may well be drifting from open discovery towards controlled ecosystems, where the winners are not just the best startups, they are the best positioned platforms and managers. This has been Nothing Venture News for May 2026 with me, Arish Shah. As always, stay hungry and stay liquid.